Every generation has financial challenges, and millennials are subject to that as well. In today's video, we're going to be looking at 10 of the millennial financial challenges and really some of the hurdles that we see when it comes to the younger generation. Right now, we're in a rising rate environment. A lot of things are super expensive. Millennials now range from age 27 to 42 is the millennial generation, which of course is the adult, the saving, the retirement, the growing, the spenders at this time, guys. So let's go ahead and break down this list. Number one, neglecting to budget. Now, in my professional career, this is where I see the biggest opportunity. Almost everybody who walks into my financial institution does not have a budget and does not budget at all, guys. Really putting it down on paper, making sure you know how much money is coming in, how much money is going out, and exactly what you have left over if you have anything left over. Now, a lot of individuals that I see are living on, of course, plastic. It is credit card, guys. That is really the borrowing aspect has become so solidified in the millennial generation that borrowing money is normal. Carrying debt forever is normal. And of course, we start at a very early age with student loans. Student loans go right into mortgages, go into car payments, go right into unsecured debt, into credit cards. There is a whole plethora of things that people go into as they start getting into a older and getting more established in life. Now, with that being said, creating the budget, I also, in my personal opinion, I feel like this is a way to really skirt the accountability option, because if you create a budget and you really do take the time and effort, write it all down, you can see in black and white if you're negative in your balancing when it comes to the month end. Now, looking at number two, excess of debt. This is one of the big things, guys, and one of the perfect ways to look at this, and the way that I really talk to individuals about, is when you look at debt, let's say you're breaking it down fundamentally with that budget, you see exactly how much you're paying on your credit card interest, your mortgage interest, your vehicle interest, your unsecured debt interest, your student loan interest. Take that and calculate it into your hourly wage. So again, if you make, let's say, $25 an hour, you're paying $100 a month into essentially nothing. You're throwing it into the interest pool that is just really funding the financial institutions. That means you got to work 4 hours to pay the interest every single month, guys. Now, when you look at the average of $600 to $700 in interest per month that individuals are paying, which again is kind of absolutely crazy, you're talking a week, probably out of every month, maybe a little bit more, that you are just giving away your entire paycheck. And think of what you're working for and how you can really make it work for that. This is really the big focus, guys, when it comes to the debt elimination. Once it's gone, you do not want to get it back. Number three, we look at overspending on housing. In the housing market right here in northern Michigan, or northern, just north of Detroit, the housing market is huge, guys, and it is so expensive. Even looking probably 5 years ago, you could buy about a $300,000 house for an average price. Those $300,000 houses right now are looking at $500,000 to about $600,000. So they have almost doubled in value in the last few years, which is kind of crazy, because if you're trying to get into a house, or if you're a first-time home buyer, it is incredibly difficult to get into the market because the houses are so high. Even looking at some locations where it was running about $85,000 to $100,000, those are now $150,000 to $185,000, which again, for an individual, if you're thinking a single person with just one income, you are priced almost entirely out of the housing market as it stands today. Now, guys, before we get into number four, go ahead and subscribe to the video, give it a thumbs up, let me know in the comments what you guys think. Let's continue with the video. Number four, impulse spending and lifestyle inflation. This again is one that I see, guys. You get a better job, you get a better car. You get a raise, you get a new house. Everything goes kind of hand in hand. You have to be really mindful with the spending, what you're saving, where the debt really is, if you're saving, how much you're investing. There are a lot of different levers as you get to this 27 to essentially that 42 age that you really have to focus on. And one of the biggest ways, guys, that I know personally is, let's say you get a 3% raise. Most people are not putting 3% more to the 401k. They're not allocating 3% more to the savings account, to the investment, 3% more to that debt repayment. They are just going year after year, getting bonuses, getting pay increases, and all of it is just coming home, and they're keeping everything status quo. Now, that is great if you're already contributing 15% of a 401k. If you're really stocking up those HSAs, those IRAs, even those 401ks, and putting more money away, guys. If you're getting a 3% raise, go ahead and allocate that 3% raise to your investment account, to that 401k. You won't even miss it, because you know what? The following year, you're going to make the exact same amount. And always automate everything, guys. I cannot stress this enough, making sure that you automate everything. Next one we look at, number 5, neglecting insurance coverage. The 20s to 40s is still pretty young. However, this is the time where insurance is going to be super cheap with a lot of insurance. As you start getting into older years, looking at health insurance, looking at disability insurance, renter's insurance, homeowner's insurance, making sure you're covering any assets that you have with insurance, guys, because as you starting a family, life insurance is going to come into play, because not only is it just worrying about yourself, now you might have a spouse or a significant other. Well, now you're adding kids into the mix. Who is going to take care of those, and what are the costs going to be associated with them? Making sure that you do your insurance check at least probably once a year. Look at everything, even looking where you can shop around and possibly get it for much cheaper, because with the competitive nature of insurance, you can shop around, and a majority of time, you can get a lot of things cheaper. Now, looking at number 6, failing to save for emergencies, guys. Again, this is another massive and crucial one, where you're going good, everything's going well, you got your paycheck, you're saving some money. All of a sudden an emergency happens. Boom, you're borrowing from 401ks, you're taking out investments. This is the reason why there is such a massive need for the 3 to 6 months of funds that are earmarked aside, that are for unforeseen expenses and emergencies only, guys. Medical bills, car repairs. This will keep you from having to go back to credit cards, going back to loans, going back to borrowing money, because essentially, when you're borrowing money, you're giving away your paycheck. You're giving away the power and the ability to invest, to create wealth, to really change everything with your family. You are giving that money away, guys. Number 7, overlooking the importance of investing. This is a huge one. When you hit that 20, 25, 30 years old, the more that you're putting into ETFs, the more that you're putting into really investments anywhere. Again, IRAs, 401ks, HSAs, long-term compounding interest is a game changer for anyone, guys. The more that you can go ahead and save, the more you can get up front. Now, education with this is huge. Knowing the basic principles, understanding some of the strategies, understanding some of the diversifications, the asset allocations, just even going through a YouTube search, checking out a couple of videos, can get really a baseline of education when it comes to investing. You're not going to be one out there building a portfolio with stocks and bonds and all this other stuff. You could, but it takes a little bit more time. But just to have the fundamentals of when you're talking to even a financial advisor, that you know exactly what they're talking about, and there isn't a lot of questions. Now, number 9, guys, again, the big one, not saving for retirement. Majority of people really start saving up and stepping up that retirement plan. Usually about 35 to 40 is when we start getting into the retirement. Well, at that point, you've lost 10 or 20 years of compounding interest, which means the money that you could have had to have a absolutely amazing, magical retirement where you'd never have to worry about money again is out the door, unless you want to put a ton of money away in a very, very short amount of time. Now, compounding interest and investment growth, you have to learn about this, guys. Do your homework, understand exactly what it is. There's actually a point where instead of you paying the bank for a mortgage, an auto loan, credit cards, everything of that nature, you give your money to the financial institutions. They pay you a return. You invest in a company, they pay you a return. That is right, guys. You really switch sides of the fence from the debt side over here, where you're paying interest on everything, to the dividends and to the interest that you're getting on the other side, where they are actually paying you for the finances that you have. And of course, guys, the last one is the wedding or the vacations, which is huge, guys. Now, on average right now in 2023, people are spending about $34,000 on a wedding. That is just absolutely money gone, guys. A wedding is one day and only one day. Make it super special. Make it the wedding of your dreams. However, you have to get that number under control, guys. If you're talking 33K, that could be a brand new car, cash paid right out of the door. That could be a massive down payment for a place that you're looking to get into. The wedding, as much as I love them, there has to be a lot of ways to cut expenses, ways to save on things. If it's doing it yourself, if it's, having it at a destination, there's a lot of cost cutting ways that you can simply have an absolute amazing day that, of course, was of your dream, but not spending the 34K that people are spending and dropping on weddings. Because again, guys, it is one single day in your life. Looking back, my wife and I, we did cut a lot of expenses. We did it on a budget, and you can make it work incredibly well. And the final one, guys, the bonus one, is the student loan repayment options. This is something that you really need to look at. If you have student loans, guys, the income-based repayments, you have to look at the deferment. You have to look at, there's a lot of different options with student loans. Now, be careful also with student loans is that if you refinance your student loan debt, so let's say I take my student loans and I move them to personal loans, or I refinance that debt into another product, you lose all of the eligibility when it comes to these student loans, including that deferment, including that repayment option based on salary. You have to make sure, guys, that you're not giving away the ability to really handle those student loans in a great way. So guys, as millennials, again, every generation does have their own challenges. Millennials kind of unique, and I believe in a situation when we look at, the 2000s, then getting into 2008 with the housing crisis and really the mortgage issues we had. When you fast forward into COVID, we have 2 wars that are going on right now. It's kind of an insane time. But again, sticking to the fundamentals, sticking to we know exactly what works will make a big difference, guys. And I'll catch you in the next video.